Alright, in this particular video, we are going to look at the accounts receivable worksheet that you can find in Blackboard. We're also going to look at some interest calculations that are on that worksheet as well. So with accounts receivable, we have two methods that we can use when we are trying to write off debt that somebody is not going to pay us. Because inevitably when we extend credit to customers, there are going to be some customers that just do not pay us. And so in order to keep our records in accordance with generally accepted accounting principles, we have to write those amounts off because our accounts receivable will be overstated if we didn't write those amounts off. Now, as I said before, there are two ways to do it. The first is the direct write-off method. This is the method that a lot of small companies use. This is not in conformity with generally accepted accounting principles. All right, but a lot of small companies do this. If you don't have a lot of write-offs that you do, then you may choose to use this particular method. With this method, with the direct write-off method, when you realize that somebody is not going to pay you, or you don't think that they're going to pay you and you're pretty sure they're not, what you're going to do is you would go in and you would write off their account. And the account that we use to write off their account is called bad debt expense. So in this particular case, we have ABC needs to write off M. Gray's accounts receivable of $2,000. So the journal entry that we would use to actually write this off would be bad debt expense. And the other side, since this is direct write-off, we're going to directly write off her account. And so it would be the accounts receivable for M. Gray. Now, if you remember when we looked at Chapter 7 and Chapter 8, we looked at those subsidiary ledgers. And so M. Gray would be the subsidiary ledger that we would be dealing with, whereas the accounts receivable is the control account. And we would actually write this amount off. And what would happen is when you looked at M. Gray's accounts receivable, you would see that she had $2,000 in it. At this particular point, we were writing it off, and so now it shows that she doesn't owe us anything because we don't believe that she's going to pay us. Now, what happens in the case, let's say that unexpectedly, a year later, M. Gray pays $1,000 of the amount that we had already written off. Well, what we have to do, we have two entries. The first one that we have is we have to reverse that write-off. So when we reverse that write-off, we would actually be recreating her accounts receivable account in the amount for the payment, which in this case is $1,000. So we're not going to recreate the whole thing because we're really not expecting her to pay. This was kind of unexpected for us. So we would just recreate the amount that she's actually paying us, which is $1,000. And that would come out of the bad debt expense account because that's no longer bad debt expense because in fact she's paid us for that. The second thing that you will see is that we have to receive that cash. So when that cash did come in, we have to receive the cash and then it will go against her accounts receivable account. And so that would put her accounts receivable account back at a zero balance. Now remember, this is the direct write-off method. These are the entries that you would see in the direct write-off method, but this is not in conformity with GAAP. This is just what a lot of small businesses happen to use. The methods that are in conformity with GAAP would be those allowance methods. And so this is GAAP, the allowance methods. Now there are three different ways and three different allowance methods that we could use as a company. Once a company picks one of these, they're going to stick with it because we want to make sure that our data is comparable. So we will stick with whichever method we choose, but a company can choose from percentage of sales. They can choose percentage of accounts receivable. They can also look at aging of accounts receivable. So in this first one that I want to look at is percentage of sales. And it says ABC accrues bad debt expense at 2% of sales. Sales are at $100,000, the accounts receivable is at $25,000, and the allowance account has a credit balance of $1,000 or $100. So what we see with this particular one being that it is percentage of sales, this is looking at the income statement approach. And so with the income statement approach, whatever amount we receive is the amount we're going to use for our journal entry. So in this one, it's percentage of sales. So we will look at the amount of sales, which was 100,000, and we would look at the percent, which is at 2%. And so what that gives us is $2,000 is what our bad debt expense should be on this one. So what we'll see is that bad debt expense for $2,000. Now the other side is going to be a new account that you haven't seen before. And this account is called the Allowance for Doubtful Accounts. And with the allowance for doubtful accounts, this is an account that is a contra asset account. And it is contra to the accounts receivable account. So that's a new account. Both of these, the bad debt expense and that allowance for doubtful accounts, are new accounts for this chapter. Bad debt expense is an expense. It's on the income statement. The allowance for doubtful accounts is a contra asset account that goes with accounts receivable. All right, and so what we're doing here is we are actually creating an account and we are matching. Remember that matching principle states that we have to match our expenses with the time period in which that revenue was earned. So with the allowance method, we are matching this bad debt expense with the period in which this revenue was earned. And so we create this allowance account, and the allowance account is the account that we're going to use whenever we do have to write an account off. Now the other allowance method that you'll see is percent of accounts receivable. Now in this one, accounts receivable is found on the balance sheet. So this is a balance sheet approach. Now what that means is that we are going to have to look at what is in that allowance account to determine what our journal entry will be using this balance sheet approach. Because the allowance for doubtful accounts is a part of the journal entry that's on the balance sheet section. So what we would do is we'd look at the percent of accounts receivable. Accounts receivable is at $25,000. Our percentage here is at 1%. And so that's going to give us $250. We need to look at the allowance account. The allowance account right now has $100 in it. We need this allowance account to be $250. Now remember, the allowance account is a contra asset account, so it is going to have the opposite normal balance from an asset account. So since assets have a normal balance that are a debit, and the allowance for doubtful accounts would have a normal balance of a credit. So in this case, what we actually are looking for is we want to know what amount is going to go right here to give us that amount. And so we would take the 250 minus the 100 and we would get $150. This is what our journal entry needs to be for. So it would be bad debt expense for 150, and then it would be our allowance account. So that allowance for doubtful accounts would be $150. and then that would give us that $250 balance. Now, I would like for you to realize that when we look at these accounts, you notice here that, that the debit account is bad debt expense and the credit account is allowance for doubtful accounts. You will see that right here. Debit account is bad debt expense, credit account is allowance for doubtful accounts. You will see the same thing when you get to the next one, which is the aging of receivables. So in this case, we see the same thing that we had before. The only difference is it's based on an aging account. So with an aging of receivables, we would take the $25,000 that's in accounts receivable and we would break it up by periods. And so 0 to 30 days, we have $15,000 that's due. 31 to 60, we have $5,000 still due. 61 to 90, we still have $4,000. And over 90, we have $1,000. Now in this case, what you see is the older that an accounts receivable becomes, the less likely we are going to be able to get that money in. And so the percentage of the likelihood of it becoming bad debt is going to be greater. So what we would do in this case is we would actually take the amount of money, we would multiply it by that percentage, and we would come up with a dollar amount. So in the first one, we have 15,000 times 1%, that's $150. Then we would take 5,000 and we would multiply that by the 2%, and we would get $100. We would take the 4,000 and we would multiply it by the 10%, and we would get $400, and then we would take the 1,000, multiply that by the 50%, and that would give us $500. So when I add all those amounts up, I get $11,050 or $1,150. So what that's saying, again, this is the balance sheet approach because we're looking at receivables. So this is going to be another balance sheet approach. So we have one approach that's income statement, two approaches that are balance sheet. Well, right now we have $1,000 sitting in our allowance account, and we need it to be $1,150. So we will need an amount here to give us that amount. And so what we are going to look at, and again you see that is coming from here, that balance came from there. So we would take the $1,150, subtract out the $100 we had, and that means our journal entry amount is going to be that $1,050. So again, you will see bad debt expense as the debit, and it will be for the $1,050, and then you will see the allowance for doubtful accounts for the $1,050. So again, this is what we're looking at. These are those three methods that you can look at and see. The one thing I do want you to realize is that if it told you that, let's say we had a $200 debit balance in this account and we needed it to be that $1,150 here because we had written off more than what we thought, then we would have to calculate, and the journal entry would be based on a different amount, and the journal entry would actually be for $1,350. So you do have to just look and see where the balance is to see what's going to happen with those accounts. Now with the allowance method, let's say that M. Gray has decided, we realize that M. Gray is not going to pay us this $2,500 that she owes us. So in this one, we already have our bad debt expense established through that allowance method. And so what we would do here is we would write off her account, but we would use the allowance for doubtful account. So it would be allowance for doubtful accounts, and we would write off that $2,500, and then we would also write off her account. So we would write off M. Gray's accounts receivable for $2,500. So the difference between this one and the very first one that we saw is that under the direct write-off method, we are using bad debt expense. Under the allowance method, when we write something off, we use the allowance account. So just make sure that you're looking at what type of method you're using, because for the allowance method, we've already taken our bad debt expense here, and so now we're just using that allowance account to kind of take care of some things. Now, what happens if she pays us the amount unexpectedly? Then what we would do is we would have to recreate the accounts receivable. That's going to be step one in what we're looking at. So with that, it would be the AR M. Gray for that $2,500, and then we would put it back in that allowance account because now we haven't used it for the $2,500. And so in effect, what we're doing is we're just reversing what we did here. And then we would receive the payment. And when we receive the payment, that would be cash, accounts receivable, M. Gray, for that $2,500. Now this is, when we look at the write-offs and recreations, they are done the same way for all three allowance methods. So it doesn't matter which allowance method we use, this is what you're going to see with these particular allowance methods. All right, the next thing that I want to look at on this is looking at those different interest calculations that we'll see. And in looking at these different interest calculations, we'll go back to that same formula that we used in Chapter 3, where we looked at the principal amount, when we looked at the rate times the time. So in calculating interest for a note that is in days, what you'll see is we'll take the principal amount, which is the $10,000. We'll take the annual interest rate. Now remember, if we just did this calculation, this would give us the amount for the entire year. We don't want it for the entire year. We only want it for 60 days. So we would take the 60, divide that by 360, and this would give us our amount for 60 days. Remember, when we're dealing with days, we use 360 days. All right, so not 365, not 366. It's 360 is what we use for these purposes. And so what you would find is that we would actually have $200 in interest that we would find. The next one looks at a monthly amount because it gives us amounts in months. So with this one, we would take the principal amount, which is $100,000. The annual interest rate is at 6%, and then we need to look at how many months we're looking at. Now, what I want you to do is use your fingers when you're trying to calculate this out. We have the whole month of June, July, August, September, October, November, and December. That is 7 months. So don't just look at it and think, oh, June, December, 6. It's not. It's 7 months. So we would take 7 divided by 12, because there are 12 months in a year. And what this would give us is an amount of $3,500 in interest. So you have to be able to calculate the interest. Now, where does this come into hand? Well, one place it can is, let's say we have an accounts receivable and we're moving it over to a note receivable because they can't pay us right now. and it's going to be paid in 60 days, but we have a 12% interest rate on this particular note receivable. So in order to establish this note receivable, we are going to increase our note receivable account. Now remember, that's an asset. We increase assets on the left side as a debit. So that's the $10,000. And we're going to be decreasing our accounts receivable account, because we are moving it from an accounts receivable to a note receivable. So let's say in 60 days they have now paid us. So we have to calculate how much interest they owe us, and we can go back to number 3 for that. So what are they paying us in 60 days? Well, they owe us the $10,000 that they borrowed plus $200 in interest, and we found that right here. So, when we look at this interest calculation, it would be the $10,000 note times 12% annual interest rate for 60 days, so it would be 60 over 360. So we found that to be $200. So that's what we have, is $200 in interest for the 60 days. So they actually are going to have to pay us $10,200. Now we're going to receive that $10,200. We will have the note receivable that they're going to be paying us, which is the $10,000, and then we would also have interest revenue. And so they would pay us $200 in interest revenue. And so that would be the journal entry that you would see at maturity of a note receivable. Now we're also going to be in Chapter 11, looking at the flip side of this, we're going to look at the note payables, and they're done very, very similar to this. So it's very important that you learn this information on how you calculate interest. And whether it be, we're actually loaning somebody money or we're moving an accounts receivable over to a note receivable, it would be done the same way. So just to recap what we've looked at here, for accounts receivable, we have looked at the direct write-off method. Remember, the direct write-off method is not in conformity with GAAP. We directly write it off with bad debt expense and then to accounts receivable. It's just one step. That's it. Then the other one we have is the allowance method. Now with the allowance method, we are using an account called allowance for doubtful accounts. And at the end of each period, we will have an adjusting entry. All right, so this allowance method is based on adjusting entries. So that's how that would be done. And you would actually have the bad debt expense at the end of each period, and then you would have that allowance for doubtful accounts. Then when we get ready to write it off under the allowance method, it would come out of what we had in that allowance for doubtful accounts and out of that accounts receivable. So with the allowance method, we have two steps. We have the adjusting entry at the end of the period, and then we have the actual write-off. Under the direct write-off method, we will not have an adjusting entry. We only write it off when we look at that direct write-off. So just make sure that you look at those pieces of information, look at your questions, and make sure you understand what you're answering. I would advise you to look over your worksheet, work your worksheet on your own, compare it with the answer key that is out there, and then come back and look at the video if you have any other questions.